Hi, this is Lex, and welcome to the Fintech Blueprint. It's your podcast about fintech, decentralized finance, digital banking, investing, robo-advice, artificial intelligence, and all the other frontier technology that is transforming financial services. To get more content, like an illustrated transcript of this conversation in your inbox, subscribe at fintechblueprint.com. So without further delay, let's jump into today's episode. I'm super pleased to have a conversation around embedded finance with Simon Torrance, who's an independent researcher and consultant in the space, and who's done a ton of work analyzing the opportunity and working with companies to figure out if this financial API thing is real or not. So welcome to the podcast, Simon.
Thanks very much. Great pleasure to be here.
Of course, my pleasure. And maybe we just start off easy and let me ask you about your background and how you ended up focusing on what embedded finance is. Like, why is this even interesting to you?
Yeah, so my background is for the last 15 years, I've been focused on looking at what type of business models work best in a digital world. And obviously, the ones that work best tend to be the ones that have come out of Silicon Valley and increasingly recently China. And I've been focused on how other types of organizations can apply the lessons of those businesses to their, if you like, more traditional legacy business models and sectors. And so when you get to finance, and you look at the business model of the financial services sector, and you look at the lack of economic profit from most of the sector over the last 5-10 years, you get to think, well, there needs to be a business model change here because the sector is just not creating and capturing value. And then you look at, well, what type of business models, are effective in a digital world. You look at what's happening, from the Squares and the Tencents and the Ant Financial and so on. And you think, well, how could we apply some of that, sprinkle some of that magic dust on the financial world? And then you get into the space of embedded finance, which is really an aspect of a new type of business model that suits not only the providers of financial services, but very much so the consumers of financial services as well.
Yep, absolutely. I want to almost pause and ask the naive question, as you come at this industry with an external eye, with impartial eye. The naive question is, what is finance? What is economic profit? What is you have a problem statement of the finance industry is not working, and it's got to be repivoted to sort of a modern business model. And this is the framing of digital transformation, right? Which, if you look at Accenture and PwC and Deloitte, they've been the best digital transformation businesses have been the consultants deploying digital transformation. And so I guess just going to the root of it is like, what is finance? What is economic profit? And in your view, what's not working?
Yes, well, very good question. So, so finance, what is finance? It's obviously transfer of value, isn't it? Either in time or space, or it's also about risk mitigation, I guess, isn't it? In terms of, if you think about insurance, how can I mitigate risk in my daily interactions? And then the sectors that provide financial services, of course, are the banks, the insurers, and financial institutions like the credit card companies and loan companies and others. And what really struck me, I was doing a project for a big international bank on a business model transformation project. So they said, look, we're not, we want to think about new ways to grow and add value to our customer base. Our return on equity, which is the main metric of success for banks, is low. We can't see it rising. What do we do? And that's a question that a lot of companies, very traditional companies in traditional sectors are wrestling with, because digitization, as is shrinking profit pools in every sector. because it's increasing competition in the financial sector, more fintechs. Its regulation is changing, like open banking in financial services is affecting the old business model, et cetera, et cetera. So digitization, which goes across every sector, tends to shrink traditional profit pools. And then doing this work with the bank, I was looking, they were talking about, oh, yes, we're looking to expose APIs to third parties, but it was all very technology centric. I got to thinking, what is that really about? And then in looking at what some of the VCs were doing in this space, because the VCs and the entrepreneurs are the ones that tend to be thinking ahead and moving dynamically forward, you started to see this. We'll talk about it in more detail, exactly what it means in some examples, but this notion of embedded finance. And essentially what that is about is now, because technology has become so sophisticated, it is possible for developers to take different components of financial service capability and, a bit like other software components, to reconfigure them in ways that are much more attractive for their customers. And so embedded finance simply means, I guess, abstracting those capabilities into technology and allowing anybody, any developer, product manager from any sector, to be able to embed or add a financial service component to their proposition. And one of the simplest, I'll pause in a second because there's lots we can talk about on this, but one of the simplest sort of anchor example that everybody likes to use is Uber. I don't have to get my wallet out to pay for my taxi ride. It's been sorted out in the background. The developers have worked out how to do that. And they've also worked out how to give the drivers bank accounts that suit their lifestyles and now insurance. That's the introduction to the problem, if you like, for the financial industry. It's got a business that, and coming back to your question, what is economic profit? That means the profit after the cost of capital. It's the ultimate measure of how much resources does a business use up to deliver its services. And on average, the banks and insurance companies use up more resources in terms of capital and human resources to deliver their product to the market than they get back in terms of profit. So fundamentally unprofitable business for most organizations in the sector, looking to get worse after COVID, because COVID is accelerating digitization. And yet, on the other side of the equation, now on the consumer side, we are very badly served. People who are not well off and rich, it costs a lot to access loans and insurance. If I'm a smallhold farmer in Mexico, I don't even know what insurance is. I don't have any access to credit. So there's this big gap. There's this enormous gap between the financial needs of humanity and what the financial sector is able to deliver there. And currently, the way that the financial services sector is delivering doesn't make any money for itself. So it's a broken system, I would say.
Absolutely resonates on a number of points. I want to keep some threads going and also just still kind of ask some, I think, frustrating, narrow questions to start, which is exposing APIs. It sounds like so lewd, it's like, please don't expose your bank APIs at me. I don't know. Thank you. And it's what is the internal drive to do that? And the answer is distribution, right? As distribution is changing, how you get to a customer is changing, and therefore you want to take advantage of modern channels. And the word digitization can sometimes be a broad brush, but at the end of the day, I think in a lot of these cases, it's about distribution of product, which is why for me, this kind of bounded question keeps coming up of like, having worked with a number of global companies on your side in thinking about digital distribution, what does the bank think that it makes? We talked about the value that it wants to capture, and we've talked about the economics of the current value chain and the problems that, broadly speaking, people have with their financial lives. What does a bank think that it makes? And what value does the bank think that it adds, especially at a huge scale that we're talking about?
Yeah. Oh, wow. That's a good philosophical question, isn't it? What does it make? Well, I think it's got stuck in sort of product silos. And this is like typical for many industries that have been in existence for, in banking case, hundreds of years. We make bank accounts where you can keep your money safely, deposit accounts where you can keep your money safely. That's what we do. Or we give you loans and you can work out what sort of loan you need and we'll provide it for you. Or insurance companies will give you this sort of different type of insurance product. But I think they're stuck in, like all sort of large scale, previously successful businesses, they're stuck in that sort of world of this is what we do and take it or leave it. And of course, what consumers and customers want now, well, some of them don't even buy those. They can't even consume those services, as I've mentioned, because they're not tailored to their situation. They can't afford them, etc., etc. And so they're excluded. But what customers are looking for is something that's much more flexible, much more relevant to them, much more lower cost as well. And, and this is a theme that a lot of people are talking about now. What banks should be about helping people and businesses with their financial health. How can we live our lives and be fit for the future and be able to retire and have enough money to do so?
Yeah.
I think that's probably the key thing.
So we're in this world. It's 2021. Let's remember that there is a car that has been launched into the sun by Elon Musk, the world's richest man. Right? Like that's there's a Linux rocket that goes to the space station. That's the context. In this context, the global banks are still factories of financial product, pushing that product at individuals. We make financial health, let's go sell it. Simultaneously, there's been now somewhere between 500 billion and $1 trillion of investment into melting down the financial industry into components and into APIs that represent all of these different financial products, whether they're payments or lending or investing, whatever. And so all of this is available to developers through these exposed APIs. Please come and take them. And you've got the unicorns of, Stripe and Affirm being slightly different, but Stripe and Affirm and Square and Plaid and Drive Wealth and Finicity and Galileo and so on and so forth. So this is our world today. And the banks are saying, we've got these products. Maybe we should be playing this technology game as well. If we take a very sort of sharp turn into practical examples of what the embedded finance players are doing that's working, how do you see, the evolution, the end point of what a bank's role is in an embedded finance world and some of the tangible things, either on the bank or the insurance side, that could be deployed?
Yeah, so let's take an example here. And so Standard Chartered is quite a good example, based out of Singapore, but a big bank in Southeast Asia and Africa. And this example is quite good because their core business, like all banks, is suffering. And so they created a separate...
Just sorry to interrupt, but I just want to highlight that they're in their core business. The core business of Standard Chartered is they're in the business of suffering. Just to be suffering is their core operating activity.
How do you mean? What do you mean by be suffering?
I'm joking about your turn of phrase. That they're spreading the suffering.
Yes, exactly. That's a good point. So what they've quite cleverly, very cleverly, what they've said is that we've got the core business, which is about suffering, as you say, and we need to optimize that. But we've got to do something to get out of this rut we're in. So they created a separate unit called SC Ventures to try and invent the future and fast track that future and to do it away from all the old metrics and culture and everything of the core business, because you cannot do breakthrough innovation within the core. And that business is proving pretty dynamic now. It's spinning off a lot of ventures, working with entrepreneurs to do so. And one of the ventures is something called Nexus, which is a bank as a service proposition. And this is publicly available information. They've essentially created their own fintech business in this space, in embedded finance, and put a lot of investment into it. And they are now making that available to organizations that are themselves platforms and ecosystems in Southeast Asia, and it'll be Africa as well later on. So these are big e-commerce marketplaces that have millions of customers and also millions of merchants who are interacting on their platforms. Nexus is going to them and saying, look, we can provide you with all the financial services for you to embed into your proposition. So, for example, supply chain finance for the suppliers in the marketplace, loans and insurance to the consumers, payment services, all kinds of other things that their core bank could never dream up or imagine, and also could never get access to 13 million consumers in one go through one partnership. From my perspective, that's quite a good example of a bank that is seeing the writing on the wall and then saying, okay, let's reconfigure how we do our innovation, and then how do we get economies of scale rather than creating our own standard products that we just try and sell to individual customers. Let's create a developer platform, essentially, that allows those big platforms that themselves have lots of customers to use to reconfigure ours and other people's capabilities to suit their network. And what's interesting here, they believe that business, this new fintech developer platform, could be worth as much as the core business is in 3, 4, 5 years' time. In theory, you're doubling the size of your business by doing this activity.
I think it's sometimes so hard for people to feel around for, a lot of the story often is like, if you were to tell a McKinsey strategy story, it makes sense. And certainly McKinsey tells the strategy story, but to feel it on a tangible level is very hard. I want to kind of pull out a couple of things you've said. Number one, you can't do transformative innovation in the core. This is not necessarily the focus of what we're talking about, but this is a takeaway for anyone running a large public bank is don't give your P&L manager of the main division the responsibility to shoot themselves in the head and drive their own prices to zero and break up their customers. It's not going to work. You have to take an external step. But then number two is this example. Well, one more thing to put a pin in is, in Europe, BBVA and Santander are two examples of banking platforms that have really stressed API-led banking as a service. And I just saw that BBVA is shutting down Bank Simple after a long slog and over $100 million in acquisition price. So I think there's still question marks that we can put on whether the McKinsey case on its own stands and what the right implementation is. And then number three is, and I think this is where I'd like to focus, is articulating that intuition and that logic about what a platform is. If you are in this supply chain world, is it some guard in a shipping facility who's using an iPad to approve a loan as the ship comes in? What is a platform? And I think to the US, and I start thinking about Shopify, and you're on your screen on your phone and you're shopping for a bag, a coat, nice socks, whatever it is. Maybe you're buying a Peloton and you can't afford a Peloton because it's inappropriately priced. And so at the moment of purchase, you get a loan, and that loan's been integrated by Shopify from a firm. And Shopify took a snippet of code from a firm and put it on its site, which generated, a button that essentially underwrites that purchase. And all that a firm had to do to get exposure to all of Shopify's and all of Peloton's customers is create these APIs and underwriting engines. And then the customers of the non-financial platform are the ones who are getting exposed to the credit in that case. You can tell the same story with Stripe and payments. But I'd love to articulate that sort of like tangible real world example of where you're interacting with a quote unquote platform, but really touching financial product.
Yeah, well, that's a great example, the Shopify one. And as we know, they make something like 50% of their revenue now from these, what they call merchant services, don't they, from payments and lending and so on. So that's a great business for them. And it's about the sort of, if you like, the captive audience. And another good example is Intuit, which of course provides systems for people, small businesses, to run their business on, accounting systems and so on. And because they have this captive audience, which is using their IT system to run their business, they have unique insights into the real activity, daily operational activity of those businesses that a traditional bank just doesn't have. The bank just sees the bank account information. So those organizations, like Shopify in your example and Intuit in the small business example, they're in a potentially much better position because of that firstly, very, very close and critical relationship, and secondly, all the data that they can see flowing through their systems. They're in a better position then to offer more personalized and relevant financial services to their audiences, and also to be able to test them out quite quickly as well. So I was speaking to one insurance organization which is trying to enable Intuit to sell specialist insurance to their users. This is workers' compensation insurance. But the traditional products from the traditional insurance companies were completely very standardized and heavily structured. But of course, what the SMEs want, they want something that's much more flexible, that suits them, etc., etc. And the system needs more data to be able to make the risk profiles and the underwriting more efficient. So this organization that's now enabling Intuit to offer and keep testing different types of offers to their customers is working really well. And then they back off to either underwriters or traditional companies and say, look, this is what the market is demanding, and change the configuration of your products or the experience in consuming it. If you can do that, there's this big market that's captive out there. And then Intuit, as the intermediary, the platform owner or the ecosystem orchestrator, you could call it, is making money from connecting all these parties together and make quite good profits from providing that service. But critically, looking at the total economics of that, of the sector in insurance, you're reducing something like 50% of the insurance sector is distribution cost. So you're taking out an enormous, semi-pointless friction, 50%, from the equation, and it's reducing dramatically because someone else is doing the distribution for you. So that changes the economics of the sector quite dramatically.
Absolutely. So 2 points on my mind kind of to move the conversation forward, and I want to move in the direction of insurance in particular. The first point for folks listening is, if you want to really understand where the growth of embedded finance is going to come from, ignore the APIs and ignore the product and look at the shape of the customer. So really listen to the examples we've described around platforms. Go to the sites of these companies, of the Stripes and Affirms and so on, and look at who they're pitching to. And then go to the Shopify site, go to the Intuit site, and understand what kind of business they're running, whether that's different and distinct from a traditional bank customer or not. And I think that elucidates the opportunity for me really concretely is reaching much earlier in the intent of a customer journey. It's like Google figuring out to put ads against search rather than Yahoo doing ambient advertising. But the second point that I want to dig down on is again, ask some basics around the insurance industry. And you've done a study on embedded finance and insurance that I think nobody else has really done work on as deeply. And this is super interesting because insurtech tends to, as a sector inside of fintech, lag a little bit and follow what the other fintech sectors are doing. And so I think we're right on the cusp of more and more insurance product being littered throughout our internet lives. Can you describe a little bit the traditional insurance value chain? And in particular, for me, there's a couple of things that stick out as kind of different and weird and unusual, right? So on the one hand, insurers are these massively levered asset managers because they collect premiums, they put it into a gigantic pot. I mean, billions and billions of dollars of asset allocation. This is why Berkshire Hathaway has been so fantastic for Warren Buffett, is because it's just a huge pot of money that comes from collected premiums and sort of the mismatch in time. And so on the one hand, they're in the business of just managing money like hedge funds. On the other side, they have these crazy sort of revenue numbers because they charge all these premiums, and then they pay all of the premiums out. So in fact, the delta between premiums in and losses out really small. So the revenues are almost meaningless, which is why lots of folks get kind of confused on valuations. And then there's everything around reinsurers and the massive brokerage armies and all of that. So I think, could you disambiguate a little bit the value chain for insurance and where you think the embedded stuff fits in?
Yes, indeed. Well, you're quite right. And it was a lot of fun delving deeply into this sector because I'm not from the sector. So when you come at it from a external perspective, and particularly with this perspective of embedded distribution, and you're not, so deeply in it that you can't see the wood for the trees, it becomes fascinating actually. So, without going to masses of detail, of course, at the moment on this, and the article, does provide that. You've got the products. So, if I want to insure a car, the insurance company will create products that can support that. The products are not very flexible because the lack of the real-time data about what the consumer or the customer is doing. So they have to create quite blunt products. And the underwriting is the risk design to work out if we do offer these products at this price, then if we expect only X number of people to claim against it, and therefore there'll be something left over for us. But it's all bit done with a blindfold on. And you're starting to see now more behavioral-based insurance. So when I drive a car, I put a dongle in the car, or it's embedded in the car now, and it monitors my real driving behavior. And then that allows me to get, in theory, much more fine-grained and personalized insurance. Whereas in the past, I was a certain type of demographic. I live in a certain part of the world, and therefore the price is this, take it or leave it. So it was a very sort of blind to what really goes on in the world industry, and therefore had to be quite blunt in its products and the types of risk management that it organised. In terms of its economics, as I said, about 50% of the business is spent on distribution, because no one wants insurance. You have to have it in certain cases, of course, to drive a car, but it's not. No one gets out of bed and says, "I want insurance." It's something that everybody. As I said in my article, I said it's something that everybody needs, but nobody wants.
This is good. So we've got banking in the business of suffering and insurance in the business of things that people don't want.
Exactly. Why there's this huge 50% distribution cost is to try and persuade people that they do need it and want it and it's available, and try and sell it to them. So they have these big intermediary groups called brokers and agents, who try and persuade people to take up insurance. The problem is that that's very, very inefficient. And so, as we just talked about, if you can put the insurance much closer to the point in your life where you understand its relevance better, where it is contextual. As you say, I'm buying a product online and it's quite a high value product. This is the moment where I might buy some insurance for it, rather than me having to afterwards think about insurance, call up some sort of broker who I don't even know and I only speak to once every few years. Trying to embed it in the point where it is interesting and relevant in someone's life, or the different workflows of our daily lives or businesses, makes it much easier for people to understand its relevance, and much easier potentially for them to commit to buying it. And also, if those contexts, the people who are managing those contexts, like I mentioned the people who provide the software for small businesses, or the big e-commerce businesses, that much closer to understanding those needs and being able to insert the opportunity to buy insurance at the point of need, then you've dramatically reduced those distribution costs. I'll just take one example from the emerging markets in China, where you've got vast swathes of people who don't have any insurance at all. So if a breadwinner in a family gets injured, he or she can't provide for their families. That's a really, really difficult thing. But those people are ill-educated. They don't even know what insurance is, and let alone be able to buy it or even have access to it. So what's interesting there is that Ant Group, that provides Alipay payment system, which now nearly everybody, or many, many people in China use daily on their phone, just for their daily lives, they are acting as a distributor now for insurance, because they have that daily interaction with people, and because they have vast numbers of customers, they're able to provide much cheaper entry-level insurance, just really basic stuff, much cheaper, and engage the customer in saying, here's something really cheap. This is why it's important for you. So they're doing education as well. And here's how you can consume it really easily. No paperwork. It's all on the mobile phone. You don't have to go to nothing complicated because they've created the infrastructure to do that. And they work with a whole plethora of insurance companies that they, through their platform, connect through to the end user with the most appropriate solution. So, sorry, a bit of a rambling response, but it's that distribution piece and the contextual relevance, which I think is the key two elements here.
Yeah. So I think we've a nice job of kind of fleshing out the theme, and I'm gonna land us towards the last question, which is going to be about how tech companies and banks should be working together on this. What do you think?
I guess, well, there's different types of tech companies. There's tech companies established. There are entrepreneurs as individuals who may have run a tech company in the past. And then there are developers. And we could look at that group in those three different categories. So I would say that for the mature tech companies, we're talking about fintechs, I think, aren't we?
Yeah, well, I think the part of the framing is you've got all the banks and the insurance companies sort of with these blinders on, right? Where they're just like deposit accounts, insurance products, and they kind of cluster around where they think the demand is. And of course, on the other side, you have the Googles and the Alibabas and the large tech companies of the world that they don't care at all about finance. They care about all of economic activity and all of your life. And, if I'm a large tech company, I've attached to the human tribe as sort of a host. I live off of it. I consume its data. I'm ever present at every point, economic, non-economic, personal, social, photos, finance, whatever you want. And so as a tech company, I have a massive advantage. You've got these entities running around with blinders, screaming deposits, interest rates, at some particular points of time, trying to market against some moment, versus somebody who's attached and with you the entire time through all of your activity. And so a lot of my naive observation is Apple's a $2 trillion company. If you want to interact with financial services, you open your iPhone, you scan your face into Apple's software, you authenticate into Apple's App Store, you download apps that are formatted as applications in Apple's operating system. And again, to open a bank account, you authenticate with your Apple ID. And so all of these finance things are just features inside of the large tech organisms. And so I think my core question is, even for a big insurance company or a big global bank, how do you navigate a partnership with a tech firm? How do you navigate a partnership or an integration into a counterparty that has that shape, which I think is quite difficult?
Yes. Well, I guess with a lot of trepidation and with those big giants, because they'll just swallow you up and leave you with the leftovers. So that needs a very, very careful thinking about there. That there are, people often think that those companies control everything, but of course there's a huge, they don't. There's the rest of the economy which is being managed and orchestrated by other organizations which are close to the customer as well. So Amazon doesn't control everything. Apple doesn't control everything, let's say, yet. But there's plenty of others, or the rest of the economy, that the traditional financial world can embed into. And it needs to do it pretty fast now. And either they make bold moves and create their own platforms and ecosystems in adjacent areas. I often give the example of Ping An from China that has done this. And on the back of that has now become, I think, about the seventh most valuable financial institution in the world, because it said, rather than us remain a commodity provider of financial services, why don't we get more embedded in the lifestyle or the life activity of our markets and create our own platforms and ecosystems related to buying and selling houses or telemedicine and so on. And they've built China's biggest telemedicine system. So rather than, say, oh, we can never do that, we're a bank. If you don't use banking skills to do that, but you can hire or you can work with and incentivize trusted entrepreneurs to create new, sticky and attractive platforms in adjacent spaces, and then you can own and control them. So they run the biggest automotive marketplace in China, I think one of the biggest real estate marketplaces, and the biggest telemedicine platform. So that's bigger than Apple or Alibaba or others in those, which are huge niches. So they've been bold enough to do that themselves. Now others can copy that playbook, but they need a different mentality to do that. And that is still possible, and others are trying to do that. But then you could say, well, that's for some, that could work if you've got visionary leaders and so on. For others, the embedded route could be a sort of maybe lower risk approach where you're working with, like the example I gave for Standard Chartered, you create a separate group that is making your capabilities and other capabilities available to others, in a low-cost, high-margin way. It's a pure software business. But then you can't do this from within the core. You've got to work it. The sort of people who are fintech entrepreneurs now, they may have created their business, sold it, they're looking for something interesting to do. They look at the incredible assets of a bank or insurance company. And my God, if I could have started my last business with all those assets, I would have saved myself 5 years of grey hair and stress. Well, I'm not going to work for the bank, but I'd love to take those assets. Let's create a new business together. Give me 50% or 30% of it, and I'll drive it forward. And I can overtake a lot of the fintechs in the wild, and we'll create something magical together. So I think that's another way of execution, which is increasingly interesting for the old world companies that know they can't change within the core. But this approach I just mentioned is actually quite a powerful one that leverages their skills and the skills of others.
Fantastic. Great place for us to wrap up. I think super interesting conversation, good lessons about what innovation really costs and what talent really costs as well. If folks want to engage with you, where can they find you, and what kind of things are you looking to partner with people on?
Yeah, so LinkedIn is always the best. That's the easiest way to find me. Otherwise, I'm simon-torrance.com, but LinkedIn is great. And what I'm looking to do is I've set this for my mission for this year is we've got to close this gap between what consumers and businesses need from the financial system and what's being offered, the financial service gap, let's call it that. So there's a big noble purpose in there. So that's what I'm interested in helping people with, whether they're startups, incumbents, or others.
Awesome. Thank you so much for joining.
Pleasure. Great. Thanks for that. It's really good to speak to you.
Hi, everyone. That's it for this week's episode of the FinTech Blueprint. For more technical deep dives into all things FinTech and decentralized finance, check out fintechblueprint.com and grab a free subscription to the newsletter. This is Lex, and I'll see you next time.